afternoon. Um, if you are joining us for the first time, my name is Dr. Sam Onika. This is regulatory platform um, where we discuss issues affecting insurance, regulation, and supervision in Nigeria and elsewhere. During the last episode, we tried to explain the meaning of the terms regulation and supervision. And I do hope that you got that definition. We also tried to explain the essence of regulation and supervision. So this morning, we want to proceed by looking at insurance business as object of regulation. And by this, we are trying to explain what insurance companies do in reality and what the regulator is to regulate and to supervise. So I am going to begin by explaining insurance business. Now, the insurer is typically a financial institution. And by that, I mean that the insurer is like the bank, like the capital market operator, like a dealer, if you like. And so they all deal on financial instruments and monetary instruments. The difference is in the nature of what they deal with, but essentially they are all involved in financial transactions. They are all into the business of intermediation. So what it means is that any regulatory issue that affects the bank, capital market operators, even pension will also apply to insurance. And so insurers are also regulated by these rules that you may call of general application. But then we are going to look at what makes insurance distinct from other financial products and why the regulation of insurance is important to us. I want to begin by explaining that insurance business is designed to provide security financially, though, for people who may experience a loss. Somebody may experience loss through death in the family, death of a breadwinner, and there is no way you can restore the dead. You can't bring back the dead, but you can help the family financially. If the man or the breadwinner had taken up insurance in his lifetime, while the family sorrow over the death of the loved one, but they have some assurance, they have some comfort that their life can continue in the absence of the breadwinner. So to this extent, life insurance cushions loss of the breadwinner. At the same time, with respect to non-life insurance, you buy a car, which is a huge investment, and you may not be able to replace the vehicle if it is destroyed either by a fire, or if it is stolen, or if it is damaged, possibly beyond repairs. So what do? You buy an insurance and you pay a small premium, and then you have confidence, you have some comfort that in the event of the car being destroyed, as the case may be, you can make a claim against the insurer. And so insurance is about financial protection, whether in terms of life or in terms of property, as the case may be. Now, there is something else I want to bring out at this point, and this is the fact that insurance is not like other financial products, especially with respect to banking products. If you have some money in the bank, say 5 million naira, the bank knows that the obligation to you is not more than 5 million naira. So if you are coming back to the bank to withdraw your money, they know you are going to ask for 5 million and nothing more. But with respect to insurance, you buy an insurance product and pay premium, let us say 500 naira premium, and the product is worth 50,000 naira. So what you're paying as premium is not equal to what you're going to receive as compensation in the event of the risk insured against being crystallized. So I want you to understand that And this is the major business of the insurer. So the insurer is in the business of providing security, financial security, and doing this using expertise, using mathematical calculations to decide and determine what actually is the probability of the loss, and if the loss should occur, what is going to be the maximum probable loss. For example, when a building is destroyed by fire, you go to that building. If it's a building that is strong and you can still find some pillars that they were not destroyed, you can still find a few things you can still build upon. And so what it means is that no property or no loss can be exactly 100%. So the insurer will estimate the maximum probable loss and also estimate the probability of the loss occurring in the first place, and be able to work out mathematically what you can pay as premium. So insurers do this, and they have experts who can do it very well, not as an individual. This is part of what they do. Now, number two thing insurers do is that they are able to carry out what we call underwriting. Now, underwriting means accepting risk and then paying out losses on the portfolio at the end of the day. Now, they do also what we call estimation of what they can pay as claim. Now, if they do this estimate rightly, they will be able to make some profit at the end of the day. And so, when what they receive as premium is more than what they are paying out as claim in the insurance year, for example, with respect to non-life insurance, they now have what is called underwriting profit. So that is one aspect of their income. And the other aspect of their income is called investment profit. Now, remember, like I said, that insurers collect this premium in advance. You pay the premium, and then you wait to see what will happen. Sometimes after 1 year, with respect to non-life insurance company, nothing happens, but sometimes something do happen. Now, with respect to life insurance, is a longer period. That's why we call it a long-term insurance or long-term assurance. Now, what happens is that the insurers accumulate this money over a long period of time and invest it in high-yield investment, instruments. And when eventually they realize this investment, they settle or pay compensation to the insured, and whatever is left out of it is also profit, and you can call it underwriting profit. Now, what it means therefore is that the insurers have both underwriting portfolio and investment portfolio. They make profit from the investment of this premium over a period of time and make profit from what they are paid as investment return. So when you now put the investment profit plus the underwriting profit, you have the total portfolio of the insurer. So the insurance business is specifically this way. The insurer collects premium, the insurer settles claim, and whatever is left becomes the profit of the insurer. So the insurance business model is designed in such a way that the underwriter receives premium from the people and settles claim at the end of the day, and whatever is left becomes the profit. Now, what is going to be regulated, or what is the interest of government in this business model we have designed? We are saying that people invest in advance, and we call it inverse exploitative cycle. And so the insurer has this money in their account. Now, it's possible, if insurance business is not properly regulated, to walk away with these funds, and that will lead to frustration and will also affect the financial stability in the system. So government is there to ensure that insurers settle claim as at when due. Now, there are laws that ensures that this happens, and that is the regulation we're talking about. By that regulation, we are looking at the financials, we are looking at the accounts of the insurer. So we're going to look at the way they have received the money, the way they have made payment to underwriters, and we'll look at also their profit. Sometimes it's possible that an insurer, after having collected premiums, is unable to settle claim. And a number of reasons will be account for this. One is that the insurer may be illiquid. The insurer may not have the liquidity to settle claim. Number two, the insurer may not be solvent any longer. In other words, much of the money that it's trading with has been filtered away, either by reason of mismanagement or because of consistent payment of claims. So the regulator is there to check the account of the company to ensure that the company remains solvent at all times. Now, if the company is seen to be insolvent, the regulator will give time for solvency to be managed so that the company can return to its condition of health. But where that cannot be done, the company is exited from the market professionally so that it will not cause any distortion to that system. So now we have seen insurance as a financial institution, and insurance as dealing in financial products, but with specific tag, in this case, insurance business. And you also seen how insurance companies make their money. They run two portfolios, and one is underwriting and the other one is investment. So when they make profit from underwriting and profit from investment, they have two profits. But sometimes it's possible for underwriting portfolio to be at a loss. But if they have investment profits, they can still be afloat. So it's important for you to understand this. We will take this on a lengthy discussion in the future, but I just want you to be sure what insurers do and how it's important for the regulator to ensure that this is regulated. Thank you for listening, and bye.